Real estate investing has always been a popular way to build wealth, and for good reason. With an abundance of opportunities out there, whether it be rental properties, wholesaling, fix and flip houses, you name it, the opportunities are endless. But the real question is, can it be possible to turn $1,000 into $1 million with real estate investing? Well, the true answer is yes. And don't take it from me, just look at some of the real estate moguls who have done it before us, including Grant Cardone, Robert Kiyosaki, and many others before them. So if you watch until the end of this video, I want to show you how to build a real estate empire with just $1,000 and a few powerful insights. Now obviously there are certain risks involved, but real estate investing can offer impressive returns over time, making it an attractive investment opportunity for those with a long-term outlook. So if you're ready to unlock the secrets of successful real estate investing and start your journey towards building your own million-dollar empire, then without further ado, let's get started. Number 1. The buy and hold strategy. In my opinion, this is the holy grail of real estate investing. The buy and hold strategy has been a popular investment approach for many years, particularly in the real estate industry. This strategy involves purchasing a property with the intention of holding onto it for an extended period, typically for several years or even decades. The idea behind this strategy is that the value of the property will appreciate over time, providing a passive source of income for the investor. Now, one of the primary benefits of the buy and hold strategy is its simplicity. Unlike other investment approaches that require constant monitoring and adjustments, the buy and hold strategy is relatively hands-off. Once the property is purchased, the investor can sit back and let the property appreciate in value over time. This makes it an ideal strategy for investors who are looking for a long-term investment opportunity that does not require constant attention. Of course, as with any investment strategy, there are risks involved with the buy and hold approach. The value of the property may not appreciate as much as the investor anticipates, or the property may require significant repairs or upgrades that eat into the investor's profits. And worse, the rental market may experience downturns, making it more difficult to generate steady rental income. Despite these risks, the buy and hold strategy remains a popular investment approach for real estate investors. With its simplicity, potential for passive income, and tax benefits, it can be an attractive option for investors looking for a long-term investment opportunity. Ready to turn your spare change into a millionaire's fortune? Watch these next tips to transform $1,000 into a staggering $1 million. But before that, please like and subscribe to the channel so that you're always up to date with our new videos. Also, share this to others so that it can spread to more people. Number 2. Fix and flip houses. If you're looking to invest in real estate, one strategy that has gained popularity in recent years is the fix and flip approach. This method involves purchasing a distressed property, renovating it, and then selling it for a profit. But trust me, while this strategy can be lucrative, it requires careful planning, hard work, and a bit of know-how to execute successfully. The first step in any fix and flip project is to find a suitable property to purchase. This can be done through a variety of channels, including working with a real estate agent, attending auctions, or searching online listings. Carefully evaluate potential properties to ensure that the purchase price, renovation costs, and expected sale price will allow for a reasonable profit margin. Once a property has been purchased, the real work begins. Renovations can vary widely depending on the condition of the property and the desired end result. Some common renovation tasks may include updating plumbing and electrical systems, repairing or replacing damaged features like floors and walls, and updating fixtures and appliances. Keep in mind that renovations can quickly become expensive, so it's crucial to create a detailed budget and stick to it as closely as possible. Experienced investors recommend adding a buffer of at least 10 to 15% to the budget to account for unexpected costs or delays. Once the renovations are complete, it's time to list the property for sale. Working with a real estate agent can be helpful in determining the optimal sale price and marketing the property to potential buyers. Number 3. Invest in up-and-coming neighborhoods. So, you're looking for a smart investment opportunity that can yield high returns in the long run? If so, investing in up-and-coming neighborhoods may be just what you need. In today's fast-paced world, neighborhoods are constantly changing and evolving. Some areas that were once undesirable or overlooked can become the next hotspot for growth and development. By keeping an eye out for these neighborhoods, you can identify and invest in areas that are likely to increase in value over time. One of the key indicators of an up-and-coming neighborhood is the presence of new businesses. This can include anything from trendy coffee shops and restaurants to boutique stores and tech startups. When new businesses begin to set up shop in an area, it's a sign that the neighborhood is on the rise and attracting attention from both residents and investors. Another factor to consider is transportation improvements. If a neighborhood is receiving upgrades to its public transportation system, such as new train or bus lines, it can make the area more accessible and convenient for commuters. This can lead to an influx of new residents, which in turn can drive up demand for housing and commercial space. In addition to these signs of growth and development, consider the overall livability of a neighborhood. Are there parks and green spaces nearby? Are the schools highly rated? Are crime rates low? These factors can all contribute to the desirability of an area and its potential for long-term value growth. Number 4. Use leverage or business credit. One of the key strategies that successful real estate investors use to maximize their returns is leverage, which is the use of borrowed money to invest in properties. Leverage is a powerful tool because it allows investors to control more property with less of their own money. For example, if an investor has $100,000 to invest and can obtain a loan with a 20% down payment requirement, they can use that $100,000 to purchase a $500,000 property. By using leverage, they are able to control 5 times as much property as they would be able to with cash alone. While leverage can be a great way to amplify returns, it's important to use it wisely. Taking on too much debt can be risky, especially if the real estate market experiences a downturn or if rental income falls short of expectations. Here are some tips for using leverage effectively in your real estate investments. Number 1. Start small. If you're new to real estate investing, it's best to start small and gradually build up your portfolio. Don't take on more debt than you can comfortably handle. And be sure to have a solid plan for how you will manage the property and generate income. Number 2. Have a cushion. Have a cushion of cash reserves to cover unexpected expenses or periods of vacancy. Make sure you have enough cash on hand to cover several months' worth of mortgage payments and other expenses. Number 5. Networking. As a real estate investor, networking with other investors can be an invaluable tool in your quest for success. By building relationships with others in the industry, you can gain insights into the market, learn from their experiences, and discover new investment opportunities that you may not have otherwise known about. One of the primary benefits of networking with other real estate investors is the opportunity to share knowledge and expertise. When you connect with other investors, you can tap into their experience and learn from their successes and failures. This can help you avoid common pitfalls and make more informed investment decisions. Just like I mentioned, networking can also help you discover new investment opportunities. By attending industry events, joining real estate investment groups, and connecting with other investors online, you can stay up to date on the latest trends and discover new markets that may be ripe for investment. You may even find that other investors are willing to partner with you on a deal, allowing you to leverage their expertise and resources to achieve greater success. Number 6. Diversify your portfolio. I cannot stress enough the importance of diversifying your portfolio. While it may be tempting to put all your eggs in one basket and invest in just one type of property, doing so can be a risky move. By diversifying your portfolio, you spread out your investments across multiple types of properties, reducing your overall risk and potentially increasing your returns. But how do you diversify your portfolio? The answer is by investing in different types of properties. This can include residential, commercial, and industrial properties, as each type offers unique advantages and disadvantages. Residential properties are a popular choice among investors as they are often easy to manage and can provide a steady source of rental income. Commercial properties, on the other hand, offer the potential for higher returns, but they can be more difficult to manage and require more investment upfront. Finally, industrial properties are typically the least risky of the three, as they tend to have long-term leases with stable tenants. By diversifying your portfolio and investing in a mix of these different types of properties, you can balance the risks and rewards and potentially achieve greater overall returns. For example, if the residential market experiences a downturn, your commercial or industrial properties may still be performing well, helping to offset any losses. The bottom line is this: real estate investing can be a great way to turn $1,000 into $1 million over time. But you need to approach real estate investing with caution and to thoroughly research each property before making an investment. With the right approach, real estate investing can be a powerful tool for building wealth and achieving financial independence. So, what are your thoughts about investment strategy? Please leave and share your thoughts in the comment section below. Make sure to like and subscribe to the channel for more videos like this and ring that notification bell. In fact, if you want to learn the top 10 golden rules of real estate investing, watch this video next, where we'll break it down in full detail. So click the video on the screen now, and we'll see you in the next one.